Welcome back, everyone, to the Weekly Buys, episode 105. Hope you've all been having a great earnings season and thriving a little bit. I know I've had, feels like half of my portfolio report in the second half of this week, which feels like it should be illegal, but between that and the conference calls, it's been a month of events packed into a few days. So if my brain is fried, you'll know why. In today's video, I've got three things. I actually got a riddle, I got stocks I'm buying, and then some earnings commentary. Now, the riddle is something that I do a lot. You're looking at two stocks going into earnings, and you can know the answer to this. It's always the same, but that won't help you. Which stock do you buy? I'll give you a second to think about it. And your hint, or what I will always say, is that this video isn't financial advice. It's purely for entertainment. Ready for the answer? If you're not, you can pause it. The wrong one. And that is what I did this week. I, before earnings, bought 2 more shares of Go Easy. I was trying to build the position quickly, and I figured, this week I will put the whole weekly budget into 2 shares of Go Easy, and earnings coming up, so want to get some in before they announce, and hopefully it doesn't run away. Well, it didn't run away. So Go Easy announced some, I would say, poor earnings, except, realistically, if a stock gets 20% return on equity, it's not that poor. It's just poorer than what was expected, and on some provisioning, which many stocks have been doing, given to the uncertainty around, the tariffs that were in the quarter and all that stuff for Canada in general. Now, I had spoken about in the past how this was 1 quarter dividend, 3 quarters growth. Well, that implied them getting basically their normal return on equity, because when you're in a financial and you're looking at equity, adjusted earnings don't cut it. You need actual value on the balance sheet, actual capital, actual equity, which they did not really improve this quarter. And even on the adjusted side, it was below normal. Now, when I look at the core metrics, the size of the loan portfolio, the size of the revenue, it wasn't nearly that bad, but stock missed on earnings, and it was not, it was the wrong decision to buy it before, obviously, in the short term, especially. Looking at, I'm not selling because of this. We'll contrast this a bit later to stocks that have done better than expected in earnings. It's okay. It's okay. It gives me more time to build a position. So there's that. And the other thing I did, which wasn't part of the plan, is I blew out the budget and I FOMO'd into buying 1 more share of Propel. Now, while that may sound like a complete joke, the whole sentence was kind of accurate, because I budget 75 to 125% of the cash flow to spend on new stocks, and so even the 1 share blew out the budget. Now, I did this because I looked at the earnings and I'm like, wow, those are really good earnings, better than I expected. Ran through the math in my head. I'm like, wow, were great earnings. This has been a very functional, very good company, and I don't even have 10 shares in the portfolio. I have 9. So yeah, now I have 10, which still isn't, a ton, but I was very impressed. I said last week that I thought that they were targeting a 25% payout ratio, and in the end, on adjusted earnings. They got something like 42% return on equity, and the payout ratio came in below the 25%. They raised their dividend a decent amount again, and very strong quarter. Now, there were reasons. It was kind of weird. It was the opposite of Go Easy, where they beat because they had less write-downs than expected, and so it's like outperforming instead of underperforming. But it was a very, very strong quarter. And the problem with this company, and I've said in the past and I'll say it again, is when I look at the range of possible results, there's a wide range. If you told me that at the end of the year this would be a $20 stock, I'd say, okay, that's possible. If you told me it'd be a $50 stock, I'd say, yep, that makes sense. So, we're at 30 something, and it's like, could it fall a lot? Yes. Could it go up a lot and have that make sense? Yes. So, and that's, it's a huge range, and that's just in the short term. If they could keep executing at a high level for the long term, that's how the stock could do very well. Now, it's a lot about a stock for that one that I have 10 shares on now after FOMOing, but I'm trying to weigh in where I think the longer term return on equity would be, because on the lending portfolio, I could see it, something like high 20s. But if you look at the services part of the company, that is kind of the wild card, because it depends how much they can get, and that could arguably be less risk on the earnings, while also having approaching infinite return on equity, because there's very little, no equity required when you're helping other people lend their capital. So I don't know how big that would be. I don't know how much that would cut into returns. I don't know exactly how much they make for incremental lending as a service. But I think the company has shown for a while that it has been a very well-run company to date. Again, I don't want this to be 100% of the portfolio, because there are some risks inherent, but excellent results, and so I added a share. The other thing that happened in the quarter is that Linamar, which I kind of said didn't really belong in this portfolio, but they increased their dividend 16%, which is a pretty good increase for 1 year. Although I must admit, it's pretty funny. I had just kind of written off their increase this year. I thought, okay, well, seeing as they're buying back a bunch of shares, they normally raise last quarter. They didn't. I thought it was going to be 10%, but I guess it's going to be 0 this year because they're buying back shares, and maybe they'll do a bit more next year. Well, that was wrong. They raised by 16%, which isn't much within the portfolio because it's a very low percentage of the dividends, but it's always nice. And I'll probably talk more about that later. Now, the portfolio notes, as I said, busy earnings season. Looking at this portfolio and looking at where all the income comes from, one of the things I've been seeing too recently is that it's lacking growth. I'm lacking the organic growth of the yield, and so that's kind of one of the things I'm working to. And because yield I have so far, so I'm working on the organic side. Now, as for a few earnings commentaries from this past week, there was Alaris, which was not very good, honestly. And that's another one of those things where you're buying it into earnings because you don't want it to run away or something, and then they put up bad earnings. Now, the FX I mentioned beforehand, but it didn't actually hit that much in that quarter. Might hit the next quarter, which was not what you want to hear when they already put up a soft quarter in Q1, but I think that might be why it was down. But the return on equity was pretty low. They took a hit from on one part of the portfolio that was hit by the Department of Government Deficiency or whatever cuts, which is fine. It was a 3 or 4% of the portfolio, and it will survive and live to pay another day. So they still have to deal with the FX. Again, they're back at a decent discount after the dunk, and I'm not concerned about the longer term of the company, but it was a weak quarter. Linamar, as I said, they raised a dividend, which is fine. This quarter is one that I would describe as a bad quarter if the stock was trading nearly fully valued and had real expectations, but evidently the market thought it was a good quarter because they're nowhere near what I think is fair value. They're pretty depressed on some pretty minimal expectations, and so having free cash flow in Q1 and having an earnings run rate above $10 is pretty good for a $50-something stock. Artis, a weak quarter. This is kind of what was destined to happen if the Iris investment blew up, which it did a few quarters ago, and so the prefs that were one of their biggest assets became a liability, and so that's why the AFFO sucked, and they're kind of treading water, selling assets, buying back shares at a discount, but it wasn't a very good quarter, and so that's why it's really hard to comment too much about Artis until the preferred share investment issue is resolved, and so yeah, that's that. And on the rest of the earnings, as I said, go easy. These are the financials. There were two where the earnings were low because the provisions were high, and that's what you get sometimes with the financials, and other times you get earnings too high because the provisions, because everything's good and you're releasing provisions and whatever. So Go Easy and MCAN were lower return on equities than expected because they were upping the provisions. Okay. Propel was kind of the opposite-ish, where it was very good because there was low credit losses, so they outperformed. And that's it for the earnings brief review. And thanks for watching. I have some other stuff coming up when I find time. As I said, it was a crazy week. Individual stocks and some general investing thoughts that should show up within the next few weeks. Have a great day. Cheers.